Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. New Disney killer Nelson Peltz will change the company forever. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. Nelson Peltz is a multi-billionaire who's also got $2.5 billion invested now in Disney stock. He invested $1 billion in Disney stock several months back. He seems to have made a profit on his investment and then come back now that Disney's stock is even lower than the price he bought in the first place. And he's looking to make a profit. He knows from his experience in industry, if he can get on the board of directors or if he can pressure the changes the company needs to make, even without being on the board of directors, he can get the company to be much more profitable again. Bob Iger clearly does not know what to do with Disney. Now, Nelson Peltz, while he's a billionaire and has already made money pushing Disney around, he's also a friend of Ike Perlmutter, original owner of Marvel before it was sold to Disney. Perlmutter was not concerned with any woke agendas. Ike Perlmutter was only concerned about what would make money. That was his complete and total focus. So when the idea for Captain Marvel came around, Perlmutter said, no, we don't need to do a Captain Marvel property. It's not something that's going to sell toys. It's not something that's going to get people excited about the Marvel brand. We shouldn't do this. Coming from Fandom Wire, we had a chance to make a great movie. Marvel's CEO nearly succeeded in stopping Brie Larson's Marvel debut. Brie Larson was almost unable to make her debut at Marvel, as former Marvel CEO Ike Perlmutter nearly succeeded in crossing out her superhero project. Ike Perlmutter never wanted this to go ahead. He was the head of Marvel. He's the one that made a deal with Bob Iger so that Bob Iger could take over Marvel and bring it under the Disney umbrella. Iger should have listened to Ike Perlmutter even if he didn't agree with the politics. If you've got someone who's actually focused on making money, they're going to gear things to what customers actually want. And that's where Nelson Peltz now comes in. Bounding Into Comics did a good article on Nelson Peltz talking about his prior histories with working with companies to try to improve their operations and how he kind of operates. This is very instructive on what he will do as he now pushes for the second time to get improvements at Disney. And let's remember, the first time around, he was able to push Disney into cutting $5.5 billion worth of expenses and laying off 7,000 people. From Bounding Into Comics, Nelson Peltz explains his objectives and his tactics when turning around failing companies like the Walt Disney Company. Investor Nelson Peltz, the founding partner of Trian Fund Management, explains his objectives and his tactics when turning around companies. Peltz recently engaged in a proxy contest with Disney and is reportedly looking to take over multiple seats on the company's board of directors. Peltz has made it pretty clear he wants 3 board seats at least so he can get himself on there, his people on there, and fix Disney. And when he fixes Disney, it's going to be about creating consumer interest and consumer demand. Certainly not diversity-driven agendas. It's not going to be what he thinks people should like. It's going to be whatever it is that people like. Give them what they want. Just like what Ike Perlmutter said when it came to the Captain Marvel movie. No one really wanted Captain Marvel, so there was no reason to make a Captain Marvel movie. In January this year, Trian Fund Management, Peltz's investment company, nominated Peltz for election to the Disney board of directors, claiming the company's share price has declined to near an 8-year low. The company has materially underperformed the S&P 500, which is other major stocks on the stock exchange, over 1 year, 3-year, 5-year, and 10-year periods by negative 24%, negative 60%, negative 66%, and negative 116%. Trian also noted Disney's operating performance has deteriorated, including a 50% decline in adjusted earnings per share since fiscal year 2018, despite parks profitability surpassing historic levels. And that's them explaining, hey, even though the theme parks and any other related travel businesses are doing really, really well, Disney's overall operating performance has declined 50% in adjusted earnings for each shareholder. That's pretty bad. After citing these poor results, Trian declared that Disney's current problems are primarily self-inflicted and need to be addressed. From there, Trian laid out that Peltz's election to the board, so if he was to join the board of directors, it would allow him to help create an effective succession plan to replace Bob Iger and align compensation with performance for the executives, because executives at Disney are being paid an absolute fortune, even though their financial results are terrible. Peltz says he could improve direct-to-consumer operating margins, eliminate redundant and/or excessive costs, and refocus the creative engine to drive profitable growth. The redundant costs at Disney are absolutely nuts. They have multiple divisions with lots of overhead and lots of extra expenses, even though nobody really loves what they're doing. One of the things you would do at a creative company would be to say, hey, look, we don't want to mess with the Pixar guys. We don't want to mess with the Marvel guys. If these guys are making a fortune for the company, you don't go and start to say, you know what, let's figure out how to combine some of these things because we're spending all this extra money on all these extra executives and all these extra offices. You don't mess with stuff like that when things are profitable. When they're not profitable, you start to say, wait a minute, I don't need all these extra offices if all I'm getting essentially is schlock content from all these different divisions. We can combine a few of these, and whatever's successful, fine. Whatever's not successful, we're going to cut. But there's no reason to have additional layers of executives and creatives making our costs go up ridiculously high, unless these people are such geniuses that they're making us a fortune. They are certainly not making anyone a fortune over at Disney. They need to realign everything they're doing to focus on giving people what they want, and those people are consumers, not executives. Giving consumers what they want, the people that are good at doing that are going to be successful for the company. The rest of these people, they really have to go. And once they have consumers happy, they will have intellectual properties that will make all their other divisions successful. Eventually, the theme parks can only be successful if they have intellectual properties that people care about. Disney is not doing that right now, so its future is not good unless they make these changes. Trian also wants to enhance accountability on capital allocation and reinstate the dividend by 2025. Capital allocation is when they evaluate, hey, how are we spending this multi-billion-dollar investment we have to get a good return on investment? If we spend billions of dollars on making films or theme parks or whatever we do, how are we getting a good return on investment? Peltz is saying you're not getting a good return on investment. There are a few things that are working, but a lot of things aren't working, and you need to adjust that. In February, Trian would drop the proxy battle, noting in a press release, quote, "We congratulate Disney and Bob Iger on their recently announced operating initiatives, which are a win for all shareholders and broadly aligned with our thinking. We are pleased with the role that Trian was able to play in helping to focus the board of directors to take decisive actions, which we believe will lead to better financial results. We were also pleased to see the company's pledge to restore the dividend." The company essentially followed all the cost cut suggestions that Nelson Peltz's Trian investment company suggested without Peltz going on the board of directors. That saved the company something like $5.5 billion in expenses, and that's fine. But they didn't make the other changes they need to make, and that's why Peltz is back trying to push them to make more changes again. This time with a $2.5 billion investment instead of a $1 billion investment, and with a demand of 3 board seats instead of 1 board seat. To get that 1 board seat or 3 board seats, Peltz needs to spend about $100 million of their own investment money communicating with shareholders, trying to say, hey, support us going on the board and replacing other people. So whether it's 1 board seat or 3 board seats, they need to spend $100 million. They didn't have to spend $100 million last time because Iger and the board of directors essentially did what Peltz said he wanted. This time, it looks like Peltz is going to spend the money, and Peltz will still get what he wants. He wants a lot more this time. Peltz had an interview with private equity guy David Rubenstein, who also has a show on Bloomberg where he interviews a lot of other people. And in that interview, Nelson Peltz explained how he goes about working with companies to try to improve them. And it is interesting to see how Nelson Peltz explains his company goes about working with companies. He told Rubenstein, quote, we're not an activist investor. What we want to do is find companies that were once great but have lost their way and then give them our plan to get back to greatness again. That's what we do. We're not there to leverage up these companies, he continued. We're not there to split them up. We're not there to do all the terrible things that typically go along with the term activist investor. We're just trying to get these companies to operate better the way they used to. When he says we're not there to leverage up these companies, he's saying we're not there to get the companies to take on a lot of extra debt, even if they can afford to take on debt. Sometimes when you take on a big load of debt as a company, you can get a better return on investment. He's not trying to get Disney to take on more debt. He's also saying he's not trying to get Disney to sell off things. He's not saying they need to sell ESPN or break up the company. All he wants them to do is operate better the way they used to when they were making a lot more money. Peltz explains how he tries to work with companies. He goes out, he buys a bunch of stock in a public company, and then he contacts the CEO and says, hey, I'm a big shareholder. And then he explains this. Some of the CEOs are much more receptive to hear what we've got to say. We put together a white paper, and a white paper is basically an analysis, a study of where a company is at, what the company's strengths are and what the company's weaknesses are, and what a company can do to improve itself. He goes over the white paper with the management, and then that white paper stays private. It doesn't go out to the public as long as they're talking to the CEO and they have a good conversation. But the white paper then becomes good leverage over the company to say, hey, look, this is our analysis. It's very well thought through. You know it's well thought through. When we put it out to the public is probably going to agree with us about how you can get an improvement in your current stock price, and we will keep this white paper and this analysis quiet unless you stop talking to us. If you're going to show us that you're not going to go forward with any of the suggestions we have or disprove to us where our analysis is off, then we are going to go public and we are going to make a mess out there for you, and it's going to be you versus us. Once that white paper is public, the public can choose a side. If the stock hasn't been doing well, a lot of the public tends to go on the side of Nelson Peltz. And Peltz has done this before with multiple other big companies successfully. Here's how CEOs tend to respond to Nelson Peltz and his investor group Trian. Clearly, they're not thrilled to see us, but what usually happens is that these stocks go up, and they go up nicely for the right reasons because sales have gone up, market shares have gone up, earnings clearly have gone up. And we tell them what we think they're doing wrong, he asserted. Peltz then provided an example with Procter & Gamble. Quote, the most recent one, which is really interesting, was Procter & Gamble. Procter & Gamble was about a $70 stock for almost 10 years. The biggest consumer company in the world, but really giving away market share here and there whenever anybody would challenge them. We didn't think the company was structured properly. So we went to them and we gave them a plan and said, look, there's one CEO. No one has profit and loss responsibility in this company anywhere other than the CEO. So there's really not an ability to impact things because everything was a matrix organization. Now, it's important to understand what the heck is a matrix organization. Unless you're really into corporate organizational structure, you've never heard of a matrix organization before. It's much worse than you think it is. A matrix organization is a company structure that is organized in a way that there are two or more bosses in charge of every project. For example, instead of reporting to only one department head, employees also report to project managers. If you've got a division at Disney and your job is to produce content and sell it to the marketplace, you've got more than one boss, and basically no one's got accountability for the profitability of any of that stuff. In addition, God only knows what they're doing with their diversity head. Is everyone in the company also reporting their plans to the head of diversity over at Disney? It's extremely likely. But even if that wasn't the case, they still have more than one boss. And the purpose of having a boss in the first place is to keep everybody focused on what's important. So when you split people's priorities, they can't have one constraint or one focused result of profitability or even pleasing your customers. You've got multiple people you need to please who have multiple agendas. It's not even just the woke agenda, it's multiple agendas. Going back to Procter & Gamble, Peltz recalled, we gave them our structure, they rejected it. We had a proxy fight, we finally won our board seat, and the shareholders won. From there, he used Heinz as an example, the ketchup company. Quote, look at Heinz, which was our first really aggressive salvo. We became a very large shareholder of Heinz. We went to them with a plan. They then didn't want any part of us. They didn't know who we were. And Heinz had a 10-year stint of flat to down sales and earnings the same. And what we saw at Heinz very clearly is that every quarter, every year, their direct market spend declined. So the direct-to-consumer marketing was reduced. In fact, at the time at Heinz, they were spending less on consumer marketing than U.S. Steel. It's a consumer product. You've got to attract consumers. What are you doing? Peltz went on to explain, quote, okay, so everybody probably has a bottle of Heinz in their pantry. The key was, how do you get it out of the pantry, on the table, and turn it upside down? That wasn't happening. So what we did is we said to them, you've got to raise your direct selling expense. Well, why do they keep it going down? You know yourself, if there are estimates of earnings in the next quarter and it's in the middle of the quarter and your CFO comes running in and says, quote, we're not going to make consensus, meaning we're not going to make the amount of money that analysts expect we're going to make in profit. There's very little that you have impact on in that quarter for that quarter except advertising spend. So Peltz is saying they were not investing in their brands. They were not spending the money they needed to spend to promote their brands. And he's explaining the reason they weren't doing that was because they were trying to hit earnings estimates that analysts had suggested the company should earn. And that's understandable. But you can't destroy the brands just because you're not going to meet what the analyst expects you're going to meet in terms of earnings. You've got to communicate with those analysts. You've got to talk to people and say, hey, look, this is what's going on with our brand. This is how we're growing it. And these are the numbers that you should expect. Peltz then shared what Heinz did. Quote, so what they did is cut advertising spending, making the quarter. But what was going to happen in the next quarter? Where was the wind at their back for the next quarter to get sales going again? Quote, so what happened is when we're all said and done at Heinz, advertising spending was about 1.5% of sales. That's probably what U.S. Steel spends on advertising. When we left the company, we sold it to Warren Buffett, Berkshire Hathaway, of course, and the Brazilians, the same people that happen to own a large part of Bud Light and Burger King, among other major brands. Spending got close to 5% of sales, and we had 36 straight quarters of organic sales increases. There was no other consumer company that could say that, he recalled. 36% straight quarters of organic sales increases is tremendous. This means that consumers are interested in what it is that you're making and they're supporting it and they're out there buying it, and that increases the value of your brands. Whether it's for ketchup or it's for Marvel, it's essentially the same thing. The key part is that consumers want what you are making and consumers are excited about what you are making. So Nelson Peltz's history is to focus on what people, actual consumers, like about each of the individual brands that a company owns. He's also focused on getting rid of that matrix structure where you have multiple bosses and no one's really accountable for profitability. Peltz wants profitability, he wants accountability, he wants money going into accountable projects where you can look at what the results are for the investment, and he wants consumers to be happy and buying and using the product. This is very different than what Disney has been doing up until this point. We still have to see how things work out with Nelson Peltz and the changes he wants for Disney, but considering he's got $2.5 billion in Disney now instead of $1 billion in the past, it means he's dedicated to seeing change happen at Disney and seeing that change happen forever. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.